This one candle right here is where thousands of traders got forced out of their positions. Not because of the war, not because the market was weak, because the market needed them to sell. And once you see exactly how it did that on this real chart, step by step, you'll never read a price move the same way again.
Let me take you back to early March 2026. The headlines are everywhere. Iran war, oil surging past $100, then $110, then threatening $120 a barrel. The S&P is down 4%, then 6%, then 8%. And something shifts in your head. If you're a beginner, you panic, you sell, you just want the bleeding to stop. If you're experienced, you think differently. You say, this is the opportunity. This is my dip. You buy, you size up, you feel calm, confident. You've done this before. Then the market drops again. Your stop loss gets hit. You stare at the screen for a second. That shouldn't have happened. You're out. And then it happens. The very second you exit, the market doesn't just bounce, it explodes upward. No chance to re-enter. No second entry. Just gone. And you're sitting there watching it move without you. That feeling, that frustration, that confusion, I understand what you feel because I've been through all of them. And I know that's not a trading mistake. That's not the news. That's not the war. Something on this chart made that happen to you on purpose. And I'm going to show you exactly what it was.
It's all here on this chart. But here's what should make you uncomfortable. This exact pattern happens over and over again. Different news, same sequence. Breakdown, panic, stop outs, and then reversal. Have you ever stopped to think, why? Is this the biggest coincidence in the market? Or something is causing it? And once you understand what that is, you'll stop reacting to the market and start seeing what it's actually doing. And once you see this, the market will never look the same again. Quick note before we start. Nothing in this video is financial advice. This is for educational and entertainment purposes only. Always do your own research and consult a licensed professional before making any investment decisions. So let's go back to this moment right here. This candle where most people got stopped out. To understand why this happens, you need to understand one thing. Big institutions don't trade like you. When you buy, you click a button. When they buy, they're trying to move billions of dollars without moving the market against themselves. And that creates a problem. Because if they buy too aggressively, price shoots up before they're fully in. So instead, they do the opposite of what most people expect. They don't chase price up. They create conditions where people are willing to sell. And where do you think the most selling happens? Right after a breakdown. Think of it like this. Imagine trying to fill a massive swimming pool without anyone noticing. You don't turn on a huge pipe all at once. The water level rises too fast and everyone sees it. Instead, you run a hidden hose, slowly, quietly, drip by drip. And by the time people realize what's happening, it's already done. That's how large orders get filled, quietly, gradually, and often right when everyone else is doing the opposite. Most traders look at this pattern and call it a bear trap. And they're not wrong. But a bear trap just tells you what happened. Stealth liquidity tells you why. And once you know why, you'll never fall into the trap again. Now, come back to this chart. That drop you saw earlier, that wasn't just fear. That was liquidity being created. Every stop loss that got triggered, every panic sell, every short position opened, that's what allowed large players to take the other side.
And on March 20, 2026, that's exactly what happened. I've circled this candle in yellow. I call this the trigger
because this is the candle that started everything. Look at the volume bar underneath it. It's massive, significantly bigger than every candle around it. What does that mean? It means a huge number of shares changed hands that day. The war headlines hit. Panic set in. Retail investors, beginners, people watching the news, they couldn't take it anymore. They sold, all at once, into this candle. But here's the question nobody asks. Who was on the other side of that trade? Someone had to buy every single share they sold. And that someone was not panicking.
The next day, the market bounces slightly. And this is where the experienced retail traders step in. I call this moment the setup, because this is exactly where the trap gets laid. They see the bounce. They say, okay, the bottom is in. They buy right here, at this blue line. And they do what every trading course teaches them to do. They place their stop loss just below the low of that March 20 candle, below the prior low. Textbook risk management. Logical, disciplined, correct, in theory. But here's what they don't realize. The institutions haven't finished buying yet. They still need more shares, and they know exactly where those stop losses are sitting. So what happens next? I call this the sweep. This is the moment you got hunted. They push price lower, deliberately, just enough to pierce below that prior low, right into where every stop loss is sitting. And the moment price hits that level, every stop loss triggers automatically. Those traders are forced to sell. Not because they want to, not because the market is actually collapsing, because they have no choice. And the institutions? They're sitting right there, absorbing every single one of those forced sell orders. That's what they needed. That's their liquidity. Retail's pain becomes their position.
And now, the final step. I call this the launch. Look at this green arrow. The second the sweep is complete, price doesn't slowly recover. It doesn't grind higher over days. It launches immediately, aggressively. And now you know exactly why. The institutions have everything they need. They own their full position, and there are no more forced sellers left. So price has only one place to go, straight up. If your stop loss got triggered, you watched this from the sidelines. If you knew what was happening, you rode every single one of these green candles. This is stealth liquidity. And now you've seen it on a real chart in real time. Because big institutions can't buy until someone is forced to sell. And in March 2026, they made sure someone would. That someone was you.
You just saw it happen, step by step, on a real chart. The trigger created the fear. The setup caught the smart ones. The sweep stole their shares. And the launch left everyone behind. That's not a coincidence. That's a system. And here's the truth most traders never learn. You didn't lose because you were wrong about the market. You lost because you were trading the news, while they were trading your reaction to it. Two completely different games. And nobody told you there were two games being played. Until now.
If this just changed how you see the market, hit the like button right now. It takes 1 second, and it tells me to keep making videos like this. Now that you see the system, let's talk about how you use it. Because knowledge without action is just entertainment. Here are 3 rules. Simple, practical, and directly connected to everything you just saw on that chart. Rule 1. Watch price action and volume, not headlines. When the news is catastrophic, most traders only watch the price dropping. But price alone doesn't tell you the whole story. Here's exactly what to look for. Price is falling hard, and volume is spiking massively at the same time. That combination is everything. The massive volume tells you a huge amount of shares changed hands. The hard falling price tells you retail is panicking and dumping. But together, they tell you someone large is on the other side, quietly absorbing every single share being sold. They didn't panic. They didn't sell. They bought. Quietly, deliberately, while everyone else was dumping. Remember that candle on March 20? Price fell hard. Volume exploded. That was your signal. Not the headline, not the war. The price action and the volume together.
Rule 2. Never place your stop exactly at the obvious level. Everyone places their stop below the prior low. Every single trader. Which means the institutions know exactly where to push price to collect maximum liquidity. So either give your stop more room than feels comfortable, or better yet, wait for the sweep to happen first. Let them hunt the obvious stops. Then enter after the sweep is complete. Because that's exactly where the launch begins. Rule 3. When the fear and greed index hits extreme fear, stop and start watching. There is a free tool called the Fear and Greed Index. It measures market sentiment on a scale from 0 to 100. 0 means extreme fear. 100 means extreme greed. In March 2026, it hit extreme fear. And here's what most people don't realize about that number. Extreme fear doesn't mean the market is about to collapse further. It means most people have already sold, which means the institutions are almost done collecting, which means the launch is close. So when the fear and greed index hits extreme fear and you feel the urge to sell everything, pause. Take a breath. Because that feeling of panic, that's not your instinct protecting you. That's the system working exactly as designed. Now, a quick note on how to apply these rules depending on who you are. If you're an investor, someone building wealth over years, Rule 3 is your most powerful tool. When the fear and greed index hits extreme fear and everyone around you is panicking, that is historically one of the best times to add to your position. Not abandon it. Zoom out. Think in years and let the panic work for you. If you're a trader, someone actively managing positions day to day, the 3 rules don't just work together. They work in sequence. First, wait for Rule 3. When the fear and greed index hits extreme fear, that's your starting signal. It tells you the panic is at its peak. It tells you the institutions are almost done collecting. Now you start watching. Then wait for Rule 1. Watch the price action and volume closely. You're looking for that specific combination. Price falling hard and volume spiking massively at the same time. That's your confirmation that absorption is happening. Now you start preparing. Then Rule 2 confirms your entry. The sweep happens. The obvious stop levels get hunted. And the moment that sweep is complete, that's where you buy. Not before the panic, not during the sweep, right after it. Because that's exactly where the launch begins.
Remember that feeling we talked about at the beginning? Watching the market explode upward the very second you exited. That frustration, that confusion, that shouldn't have happened. Now you know why it did. And here's what I want you to understand. You were never a bad trader. You were never unlucky. You were never too emotional. You were simply playing a game without knowing all the rules. The institutions weren't smarter than you. They just had a different playbook, one that nobody handed to you, until today. And that changes everything. Because the next time you feel that panic, the next time the headlines are screaming, the next time your finger is hovering over the sell button, you'll pause. You'll go to the chart. You'll look for the pattern. And instead of being the one who provides the liquidity, you'll be the one who sees it coming. That's the shift. From reactive
to strategic, from prey to predator. That's what precision capital is built on. Not tips, not predictions, not noise. The actual mechanics of how markets move. And you've just seen them for yourself.
If this was your first time visiting our channel, welcome. Subscribe to Precision Capital so you don't miss the next breakdown. I'm going to keep showing you real setups, real charts, real mechanics, no fluff. And I want to hear from you. Drop a comment below. What pattern, what market moment, what question do you want me to break down next? Because the next video starts with you.